Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing BP stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. BP is a multinational oil and gas company. It is one of the world's 7 oil and gas super majors. They are a vertically integrated company operating in all areas of the oil and gas industry, including exploration and production, refining, distribution and marketing, power generation, and trading. It also has renewable energy interests in biofuels, wind power, smart grid, and solar technology. The company is headquartered in the UK and was founded in 1909. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Xetra, Börse Stuttgart, BATS, and London Stock Exchange. Let's get started with the model. This is a large cap company, 95 billion market cap. They're trading at $28 a share, and they have 3.4 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow goes up 50% from 2019 to the trailing 12 months. It was a small negative in 2020. Net income is the profit or loss on the income statement. It's revenue minus expenses. And they have a big negative in 2020 and the trailing 12 months, positive in 2019 and 2021. Revenue is a sales for the company, and you can see that's actually going down each year from 278 billion to 172 billion. I'll explain a little more of this later. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And that does look pretty good in the trailing 12 months at 25 billion. It's up about 150% from 2020. Below that is our operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. And that was 16 billion in 2019, currently 12 billion. They received 338 million of interest on their investments. They paid 2.6 billion of interest on their debt, which is lower than 2019, 2020, or 2021. They paid 238 million of financing costs. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income. They do have a big negative in the trailing 12 months. I would just focus on operating income when I look at the income statement, not so much net income, because large asset impairments can really drag down your net income and skew the numbers. You see Yahoo Finance has revenue of 278 billion in 2019. That is what they reported in 2019. But they revised this number recently. They also revised the 2020 number of 180 billion. That's overstated as well. The 158 billion in 2021 was not revised. This is from the company's 2021 annual report. Their revenue in 2019 is 159 billion, 2020 is 106 billion, and 2021 is 158 billion. These are the accurate numbers, not what's on Yahoo Finance. What's on Yahoo Finance is what the company originally posted. So if you look at the company's 2019 annual report, you'll see that 280 billion of revenue. Here's a footnote on the income statement. 2020 and 2019 revenue has been restated due to derivative contracts. I know there's some people watching this that may be a little confused. How would I know the revenue was overstated initially, and how would I know that it's been restated? A good way to eliminate all the accounting noise is just to focus on the statement of cash flows. The statement of cash flows shows the actual cash the company generated. It eliminates all the accounting manipulation. So you can see how smooth the cash flow is. They generated 26 billion of operating cash flow. Same thing in the trailing 12 months, 26 billion. 2020 was low because oil prices were low. They only generated 12 billion of cash flow. Operating cash flow is like net income, but converted to cash. Then you have capital expenditures, which are investments in property, plant, and equipment. A company like this spends a lot on CapEx in building out its infrastructure when it has oil and gas projects. The value of those assets are carried on the balance sheet and depreciated over their useful lives. They're depreciated onto the income statement. Operating cash flow minus CapEx gives you your free cash flow, and that was over $15 billion in the trailing 12 months. They do pay a dividend with the free cash flow. They also buy back stock. They bought back $3 billion in 2021, $800 million in 2020, and $1.5 billion in 2019. When a company buys back its own common stock, that decreases the shares outstanding. It makes your shares more valuable. Let's look at the capital structure. $63 billion of equity, $69 billion of debt. They're 48% equity, 52% debt. And their net debt is $35 billion. So if they wanted to, they can use the cash on their balance sheet to pay down nearly half their debt. And the WACs on Finbox range from 8% to 9.3%. I use the middle one of 8.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $131 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $123 billion. We divide that by 3.4 billion shares, and we get a calculated stock price of $36. They're trading at $28, so they're trading at a 22% discount. So it's a buy according to the model. The last time I did a video on this company was a few months ago in December. They were trading at $26. My target was $29. And they're getting pretty close to my target. They're at $28. My new target is $36. The company's revenue forecast for 2024 is $184 billion. For 2023, it's $188 billion. And for 2022, it's $193 billion. I continued this trend into 2025 and I got $180 billion. That's how I got their future revenue estimates. They convert on average 5% of their revenue into free cash flow, so I multiplied their future revenue estimates by 5%. That's how I got their future free cash flows. The website Simply Wall Street pretty much values the stock exactly where they're trading at. So they're saying the stock is trading at intrinsic value. There are 4 analysts pricing this stock, and the average price target is $35.33. The lowest price is $31, and the highest price is $39. This is where the stock has been trading the last 5 years. Before COVID, it was well over $40 a share, almost $50 at the beginning of 2018. Then in March 2020, it fell to $18. A few months later, it fell to $16. And it has doubled since that point, but it's come down a little bit in the past couple of weeks. But it's interesting to see it's trading at a pretty big discount relative to its pre-COVID highs. This red line is the price of Brent crude the past 12 months, which is up 56%, and this stock is only up 6%. Brent crude and this company's stock price were tracking each other almost identical for several months. Then at the end of February, Brent crude just took off, and this stock actually went down a little bit. It's really interesting to see that this stock price and Brent crude have diverged so much. They used to pay a 60 or 63 cent dividend. They cut that to 33 cents, but it's still a pretty good yield, 4.7%, which is 30% of their free cash flow. So they definitely have room to grow their dividend or use the cash for other things. Their dividend yield was fairly steady from 2011 to 2019. Then when the stock crashed, the dividend yield shot way up to over 10%, and the forecast is for the yield to be over 5% by 2024. The last time they did a stock split was 23 years ago at 2-for-1. They also did a 2-for-1 in 97, 80, 78, 73, and 64. They also did 11-for-10 split in 67. They have a pretty low beta, 0.7, so the stock is not too volatile. It's gone up 3% in the past 52 weeks, while the S&P is down 13%. The 52-week low is 23, the high is 34. And the stock is on a downtrend, trading below its 50-day and 200-day moving average. This is a really popular stock. 13 million shares are traded each day. Most of the shares outstanding are on float. 9% are held by institutions, and 0.25% of the shares are shorted. If you put $10,000 into this company 10 years ago, you'd have $13,000 today. That's a 26% return, a 2% annual return. The CEO's salary has been pretty steady at $1.8 million, but their total compensation package is up the past year. It's currently at $6 million. 72% of the company is held by institutions, 26% by the general public, 1.5% by their employees, and a small percentage by private companies, the government, public companies, and insiders. Their employee count has been going down slightly over the years. It looks like it was about 75,000 employees in 2016. Now they're at 66,000. Here are their top 10 biggest shareholders. BlackRock at 10.5%, Vanguard, Norges Bank, State Street, Franklin Resources, UBS, Capital Research, Legal & General, BP Employees, and Safe Investment. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a really good price to sales of 0.6, that's stock price over sales per share. The market median is 2.8, the market average is 9.3. Price to book of 1.5, and a price to free cash flow of 6.3, that's stock price over free cash flow per share. Their return on invested capital is 10%. They can cover their interest payments with their EBIT 4.5 times. They have a negative ROE since they have negative net income. They can cover their current assets with their current liabilities. Their quick ratio is slightly below 1. And they do seem to be pretty well capitalized. They generated over $15 billion of free cash flow in the trailing 12 months. They have $19 billion of working capital, and they pay out $4.5 billion of dividend payments. The best way to look at ratios is to compare them to companies in the same industry. There are 19 companies in the same industry as BP, and if BP has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend more than average in CapEx. They are more leveraged than the average company. For every dollar of equity, they have $1.10 of debt. They pay a high yield relative to the average. They generate more free cash flow than the average company. They rank 6th in market cap at $95 billion. The average is $88 billion. Their price to book is average. We can't look at their PE since they have negative net income. Their price to free cash flow is good, but it's worse than average. They have a really good price of sales relative to the average. They generate lots of free cash flow, but their 5-year revenue growth rate is declining, and they have a negative ROA and ROE since they have negative net income. So to summarize, I have them trading at a 22% discount, and this company is a giant oil and gas company of Britain. So the British economy really relies on this company because we know how important oil and gas is, and they also pay a nice dividend. Even though they cut their dividend, the yield is a lot higher than the average. I rank their free cash flow as 9 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.